You've heard of the Magnificent Seven stocks, but they're not the only tech stocks you should know about. Today, we're going to talk to an expert investor about 8 tech stocks that everyone's missing and why they could be magnificent for your portfolio. So let's get started. This is Ticker Take. Caroline, you're looking small today.
Well, it's sort of our theme today, John.
I thought we were talking about tech stocks.
Well, we are, but these are smaller tech stocks that some investors might not know about.
Oh, I get it. You're smaller because they're smaller.
Exactly. So, on that note, let's hear from today's guest investor, Ryan Modesto.
All right, Ryan, welcome back to Ticker Take. Great to see you.
Great to see you. Thanks for having me.
Now, you focus on small to mid-cap companies. Everybody's been talking about the Magnificent Seven, but what are the benefits for investors in looking beyond those biggest stocks?
For us, it's just the opportunity set. You know, it's Russell 2000 versus the S&P 500 or the NASDAQ 100. So it's just multiples and multiples more opportunities to look at, more stocks to turn over, more rocks to turn over. And you also get smaller companies in that space as well. So smaller companies tend to be able to grow a bit faster. They can kind of pivot their strategies a bit quicker than maybe a larger company could. So there's just a lot more interesting companies to unearth in the smaller companies and a lot more companies to look at as well.
And today we're going to be talking about a whole range of companies from software and space to AI. But what is vital? What's really important for you when you're trying to determine if a specific stock is actually worth buying?
Well, that's kind of the tricky thing. It's such a big market in the small and mid-cap space. There's so many companies to look at. It can be a bit overwhelming. So you kind of have to create a bit of your own sandbox and figure out what you like to look at, what resonates with you. So for us, that's growth, momentum, and quality. On the growth side, we typically need to see above average top line revenue growth. If a company's not growing their revenues, we're not too interested in the name. On the momentum side, we like both fundamental momentum, so things like earnings, revenues going up, balance sheet improving. We also like stock momentum as well, so things going up and to the right. And typically that means when things are moving in the right direction, things are going right, more investors pay attention, and you kind of get a virtuous loop on that side of things. And the final one is quality. So we like strong balance sheets. It gives companies the flexibility and the ability to weather a downturn or put cash to use when opportunities might arise.
All right, with that said, let's hear about the 8 tech stocks that Ryan is watching. But first, this is not financial advice. Stock number 1, Karman Holdings.
Well, this is a relatively new stock because they had an IPO. They went public this year. It's in areas that are very much talked about: defense, space. It doesn't have a lot of coverage on Wall Street, but the analysts who cover it like it. Can you tell us more about it?
Yeah, it's ironically, considering how well it's doing, it's a bit of an under-the-radar name. They're a vertically integrated missile manufacturer and rocket manufacturer. So as you mentioned, they hit on hypersonics, missile defense systems, and space launch systems as well. There's a really big restocking going on with missiles, and Karman should benefit from that. And they also should have some exposure to the Golden Dome if or when any Golden Dome movement actually happens.
Can you just explain that too?
So that's the defense system that the U.S. is looking at to kind of cover the skies and protect them from any incoming rockets or missiles and things like that. A Wall Street Journal story just came out a few days ago where they said that the governments are looking to have their missile capacity increased by double or even quadruple in some cases. So there's a lot of tailwinds that are behind a company like Karman right now.
Stock number 2, Rocket Lab.
Well, at least for some investors, I'm not sure how under the radar Rocket Lab is because we get a lot of inquiries about it, and it's come up on multiple ticker takes, including one episode that was specifically on space. But even after the run-up that the stock has seen, it seems like analysts are still pretty bullish on it. And you were talking about you like those momentum stories. Give us your take on Rocket Lab.
Yeah, so in fairness, we don't own Rocket Lab currently, but if you're looking for exposure to that space theme, like Rocket Lab is one of those core pure play space types of names. And they're really enabling a lot of the space launch capabilities on a commercial basis and even a government basis. So essentially, they're just a low-cost provider for space launch systems, launching satellites, good growth. They're growing on the top line, about 30% year in, year out. And again, they're one of the only kind of games in town for that main kind of public markets type of space exposure. So a lot to like. What kind of keeps us at bay with the name is it's quite expensive. It's trading, I think, about 30 times sales, maybe a bit over that right now. So it's a name, I think, if you're looking for that space exposure, put it on the watch list, maybe give it a bit of time kind of thing. But it's an interesting name to keep an eye on for sure.
Stock number 3, Nebius Group.
Well, this is at least the third time that Nebius has come up on ticker take. So maybe like with Rocket Lab, less under the radar than it might have been coming into this year. The company's stock is still generally well-liked on Wall Street. The backstory, if people know Yandex, there's a Yandex connection here. Can you tell us about this company and the stock story?
Yeah. So it used to be part of Yandex, and obviously when all of the Ukraine and Russia conflict kicked off, it was delisted, and they went through this long process to essentially kind of carve out what is now Nebius. And so it was not listed for a really long time. They finally started trading again. And at that point, not many people really knew about it. And then they sort of started to build the story, get more knowledge across their investor bases. And what happened is the stock was trading at a $17 billion market cap, let's say a month ago. And then they recently just signed a deal with Microsoft, and that deal was a 5-year deal worth $17 billion in and of itself. So they signed a deal worth the entire market cap. This company, they did $100 million in revenues last year, and by 2027 they're expected to do $4 billion in revenue. So 100 million to 4 billion in a couple of years is just explosive growth. What a lot of people don't talk about with this name too is they have other companies in their corporate umbrella. One is called Avride, which does autonomous vehicles. And the other is ClickHouse, which is like a database management software. And both could be interesting levers the company can pull for growth down the road. There are some other companies they own as well, but those are some two kind of very interesting names, we think, within the Nebius story already.
Stock number 4, nVent Electric.
So a stock here that's had a great run, but similar to some of the other stocks we've talked about, when you look at the Wall Street view, analysts still generally like it. Can you tell us more about it?
Yeah, so nVent is providing capital equipment to the data center space. And so this one's a bit under the radar because they're actually transitioning their portfolio more towards data center type of products and services. And so they've done a couple acquisitions that's tilted what their service offerings over to more data center type companies. So you're seeing their revenues actually start to accelerate from here. And we expect that their margins are also going to increase. So when you get a case of higher revenues and higher margins, you get some kind of nice torque on the bottom line for companies like this. And they also, they're a UK company. They trade in the US, but they're a UK company. So we think they also kind of go under the radar because of that. But overall, I mean, there's the individual stock story here, but then also there's just, I think, a lot of tailwinds behind the whole data center investment that's going on right now. And that should support a company like nVent for at least a year or two here. And they just reported earnings somewhat recently, and it was a very healthy beat and raise too. So they're certainly optimistic on their future as well.
Stock number 5, Freshworks.
Well, this company has one parallel to the other companies we talked about, which is a lot of analysts like it. But one difference is the stock has struggled compared to some of the other names we've talked about this year. So what's going on?
Yeah, so this company is getting caught up in the whole AI versus software debate. And a lot of people are thinking like AI is going to eat software and people are just going to vibe code programs and create all these software programs in-house. We think this point of view is a bit misguided and it's not going to be the reality. I think the reality is that companies like Freshworks can actually use AI tools to make their products a bit better. They can use it to kind of gain an edge and upsell, get their foot in the door with current customers, cross-sell to customers that are maybe a bit more stagnant in terms of growth. And they've rolled out a bunch of different kind of chat bots and chat agents that are sort of AI powered. And these things should actually also help the margins of a company like Freshworks because they can use these AI tools and services, but also obviously the companies that they're providing it to, because if you have an AI chat bot that is doing what it would take a human to do, obviously there's a lot of cost savings there. So it's an interesting name. We think it's kind of misunderstood in terms of what they're doing. They're growing at mid-teens on the top line, and they have about 25% of their market cap is in cash. So on a valuation basis, that's, they're trading at 19 times forward earnings, but ex cash, they're trading about 15 times forward earnings. So good growth, good valuation. And we think it's a bit of a misunderstood name right now as well.
And the chatbots that they are providing to, like, what kind of customers are they working with?
Yeah, so they have two kind of businesses. They have a customer service type of business, and then they have an employee service type of business. And the employee one is actually growing quite fast at 30%, whereas their customer one's a bit more of a mature business growing in the, call it, mid to high single digits. And again, we think that's also an asset that's getting overlooked, the fact that they have this higher growth company getting overshadowed by maybe their slower growth mature company, and it's actually helping raise their margins a little bit as well. So I think there's kind of a lot going on under the hood here that's not really getting appreciated right now.
Stock number 6, Alkami Technology.
This has a similar profile, at least with the stock, to Freshworks in that it's a well-liked stock, and it's a stock that has had a rougher year as well. Can you break it down for us?
It's almost the exact same story, we think, is what's going on. It's that AI versus software debate. People are kind of throwing the baby out with the bathwater, forgetting that there's actually good companies that do software with high margins, and Alkami is one of those as well. This is a fintech company, and they provide onboarding, KYC, account opening type of software to...
What's KYC?
Know your client type of software, yeah. And they work with financial institutions in the US, but call it the major banks, so credit unions, smaller financial institutions, which there are a lot of in the US, obviously. And so we like the business. It's a nice, sticky business, right? It's kind of one of those things, when your employees, your company gets comfortable with this type of software, they're probably not going to rip it out unless they find something that's 10 times better or 10 times more efficient. So when they're in the door, they're probably going to stay there. And same as what we were talking about with the AI. So we don't think these financial institutions are going to start AI coding their own in-house tools to do this. So now Alkami is trading about 32 times forward earnings, but they have about 30% top line growth and about 65% gross margins as well. So it's just a really nice, good growth company that's just being totally ignored right now.
Stock number 7, Genius Sports.
Well, Genius is a company that you and I actually recently discussed at the Money Show. This is a business that is benefiting from the rise of sports betting. So walk us through the Genius story.
Yeah, so we view this one as a bit of a picks and shovels play on the sports betting industry. So what they do is they go out and they sign deals with different leagues, NFL, for example, which is kind of their crown jewel and actually owns warrants in Genius. But so they go out, sign these deals with leagues, collect and analyze their data, and then turn around and license that data to the betting companies, the sportsbook companies, for a fee, obviously. And so it's one of those businesses where there's only 2 real competitors in the business that do what they do. It's Genius and Sportradar. And the industry itself is growing at a pretty fast rate. The entire industry is growing about 10% year over year. But the U.S. side of things is growing at about 20% because sports betting in the U.S. is actually a fairly new, legalized sports betting in the U.S. is a fairly new industry. So there's a nice, just call it macro tailwind behind these companies. And we think one thing that's getting overlooked with the Genius story right now is that they're rolling out an advertising business. And this ad business, essentially it's going from 0 to 1. So it's going to start ramping up and really contributing to growth. And management has said that they expect this to become like a core part of their business as well. So I think that's going to really drive growth, regardless of what's happening in the sports betting industry. We think this ad business is going to really drive growth for Genius as well.
And how does that ad business work, basically?
So they have interesting data points and access to who's watching, what sports, when certain players are making certain plays, and there's going to be an ability for them to kind of place unique ads at unique, call it, events during sports games, and then just call it your more traditional type of advertising as well.
And stock number 8, Cellebrite.
Well, this is actually one that got a nod from a big Wall Street firm, JP Morgan, I believe, in the last few weeks, gave it a thumbs up. And when you look at the analysts who cover this company, they think it is worth well over $20 a share. But explain the business and the stock story behind it.
Yeah, so Cellebrite does digital investigation software. So they are able to tap into digital devices, collect data, analyze data. And as crime's moving more and more online and it's becoming more and more complex and spreading across different devices and things like that, government agencies need better, quicker, faster, more efficient ways to kind of collect and understand what's going on on the digital side of things to be able to take cases to court and win the cases. So Cellebrite helps them do this and all in a compliant manner as well, which is really important, obviously. And so this company is growing at a really fast rate. They're trading about only 32 times forward earnings, but they're a rule of 40 company. And there's just, everything here is working really well. And we think there's been two kind of shadows or clouds that have been hanging over this name. There's been a CEO transition that kind of took a bit longer than it probably should have. So that was the one issue, and then there's also kind of a budget lockup in the US that was sort of slowing their revenues down. Both of those should now be behind Cellebrite, and we think, and you can see it in the momentum in the stock currently, but we think they're going to kind of start ramping things back up. We think there's a lot of opportunity in this name.
Now, you also talked about the rule of 40. Can you just explain that for our audience as well?
Yeah, so that is when your growth rate and your margins add up to a number at 40 or higher. And a lot of software companies use that as kind of a nice sign of just a really strong company. So
they've been enjoying that kind of performance historically.
Yes.
And so you look at that compared to where the stock is trading.
Yeah. It's less of a valuation, more of a you can maybe use it as a screener type of tool, but even on a price earnings to growth basis, if you want to look kind of relative to growth, it looks pretty attractive.
All right. Great perspective. Ryan, so great to have you back on Ticker Take. Thanks for joining us.
Thanks for having me.
All right. Our thanks to Ryan Modesto for his list of 8 tech stocks he's watching. Are any on your watch list? Give us your take in the comments.
And for takes from other investing experts, you can find them in our free investing newsletter or the podcast edition of Ticker Take. And of course, right here on YouTube. So make sure to subscribe so you don't miss our next investing video.
See you next time.